I am George Soros, and I made $1 billion in a single day by betting against the Bank of England. What I'm about to teach you isn't theoretical. It's the exact strategy I used on Black Wednesday in 1992 to execute one of the most profitable trades in history. When I saw the fundamental weakness in the British pound, I recognized an asymmetric opportunity that most traders missed. The Bank of England had pegged the pound to the European Exchange Rate Mechanism, ERM, artificially maintaining its value despite economic fundamentals suggesting it was overvalued. I didn't just see a trade, I saw a mathematical inevitability. Let me share exactly how I approached this trade. First, I identified a currency peg that was fundamentally unsustainable. The British government had committed to maintaining the pound at a specific level against other European currencies, particularly the German mark. I observed that Britain's inflation rate was substantially higher than Germany's, creating an economic tension that couldn't hold. My second principle: when governments fight market forces, the markets eventually win. Always. The British government was spending billions to defend an artificial exchange rate. I calculated they simply couldn't sustain this indefinitely. I began building my position methodically. I didn't place my entire $10 billion bet at once. That would have alerted the market. Instead, I accumulated my position gradually, shorting sterling across multiple banks and jurisdictions. I was essentially borrowing pounds, converting them to marks, and waiting for the inevitable devaluation. As my position grew, so did market pressure. I wasn't just making a trade, I was creating a self-fulfilling prophecy. The more pounds I shorted, the more other traders followed, and the harder it became for the Bank of England to maintain the peg. On September 16, 1992, the breaking point arrived. The British government raised interest rates from 10% to 12%, then announced another hike to 15% in a desperate attempt to attract buyers for the pound. I didn't flinch. I knew these were the desperate actions of a cornered opponent. By the end of that day, Black Wednesday, Britain announced its withdrawal from the ERM. The pound plummeted, and I closed my positions with approximately $1 billion in profit. One day, 1 billion pounds. The key lesson here isn't about the size of my bet. It's about recognizing fundamental disequilibrium. When economic reality and political promises diverge, reality always wins. Eventually. The timing is the only question. I've always maintained that markets aren't perfectly efficient. They reflect human psychology, political constraints, and institutional limitations. Finding these inefficiencies, these reflexive relationships where market perceptions create their own reality, is where the truly exceptional profits lie. Remember this: the biggest opportunities often exist where governments try to maintain artificial market conditions against fundamental economic forces. When you identify such a situation, position yourself accordingly, and have the conviction to withstand temporary volatility, you position yourself for extraordinary returns. That's not speculation. That's mathematical certainty working in your favor. I am Stanley Druckenmiller, and I've made billions by rejecting conventional wisdom. While most financial advisors preach diversification, I built my fortune through concentration. When I see a truly exceptional opportunity, I don't just dip my toe in the water. I dive in headfirst with massive conviction. Let me be clear. Diversification is for the amateur. It's protection against ignorance. When I identify a genuine asymmetric opportunity, I concentrate my capital aggressively. During my time running Duquesne Capital, I averaged 30% annual returns over 3 decades by focusing on a handful of high-conviction positions rather than spreading myself thin across dozens of mediocre ones. I learned this philosophy early in my career. In 1985, I noticed the dollar was significantly overvalued against other currencies. Instead of making small bets across various asset classes, I committed nearly 100% of my fund to this single trade. I shorted the dollar heavily, and when the Plaza Accord was signed later that year, forcing the dollar lower, I made a fortune. Had I diversified that position, my returns would have been mediocre at best. My approach isn't about recklessness. It's about calculated aggression. When I'm wrong, I cut my losses quickly. But when I'm right, I press my advantage with size. During the 1992 Black Wednesday crisis, working alongside George Soros, I built a $10 billion position, shorting the British pound. When the Bank of England finally capitulated and withdrew from the European exchange rate mechanism, we made over $1 billion in a single day. That kind of return isn't possible with a diversified portfolio. I've always focused on 3 key principles that make concentration work. First, I demand a significant margin of safety in my high-conviction trades. Second, I maintain ruthless discipline in risk management. I'll cut a position immediately when my thesis is invalidated. Third, I size positions based on my conviction level, not arbitrary allocation percentages. The market gives you rare moments of clarity, perhaps 3 or 4 genuinely exceptional opportunities per year. When those moments arrive, I strike with overwhelming force. During the 2008 financial crisis, I recognized that financial institutions were severely overleveraged. I concentrated my positions in shorts against financial stocks and credit default swaps. As the crisis unfolded, these concentrated bets delivered extraordinary returns, while diversified portfolios were devastated. I'm not suggesting you abandon risk management. Rather, I'm teaching you that true risk management isn't about owning 100 different stocks. It's about deeply understanding the few positions you hold. When I take a major position, I've analyzed it from every angle, understanding the catalysts, risks, and potential payoffs with crystal clarity. Remember this: the greatest fortunes in market history weren't built through diversification. They were built through intelligent concentration. Warren Buffett, Carl Icahn, John Paulson, we all made our billions by taking significant positions when the odds were overwhelmingly in our favor. The question isn't whether you should concentrate, but whether you have the knowledge, discipline, and psychological fortitude to do it successfully. I am George Soros, and I've built my fortune by taking concentrated positions when I identify asymmetric opportunities in the market. What I'm about to share with you transformed my quantum fund from merely successful to legendary. The strategy of making concentrated bets that changed everything. This isn't theory. It's what made me billions and earned me the title, the man who broke the Bank of England. When I started Quantum Fund in 1970, I was already a successful trader, but I hadn't yet made my mark on global financial history. The transformation came when I embraced a philosophy most fund managers still fear today: strategic concentration. While conventional wisdom preaches diversification, I discovered that extraordinary wealth comes from focused conviction. Here's exactly how I approach concentrated positions. I first developed a comprehensive macro thesis about significant market imbalances. I don't just look at charts or financials. I analyze geopolitical forces, central bank policies, and structural economic weaknesses. When I spot a genuine asymmetry, where market pricing significantly differs from underlying reality, I strike with overwhelming force. My breakthrough came when I realized most fund managers dilute their best ideas across too many positions. I don't. When I have conviction, I allocate substantial capital, sometimes 30% or more of my fund, to a single position. This approach requires something most traders lack: the psychological fortitude to withstand enormous volatility and potential drawdowns. Take my famous 1992 trade against the British pound. I didn't just take a modest position. I committed over $10 billion to shorting the pound when I identified the unsustainable position of the British government within the European exchange rate mechanism. While other traders saw the same opportunity but took small positions, I deployed massive leverage. The result? I made $1 billion in a single day when the pound crashed. What separates my approach from reckless gambling is my risk management framework. I never enter a concentrated position without establishing clear exit parameters. I'm ruthless about cutting losses when my thesis proves wrong. Remember, I'm not right because I'm George Soros. I'm George Soros because I know how to be wrong. The quantum leap in my fund's performance came from understanding that asymmetric returns require asymmetric positioning. When most traders find an edge, they apply it timidly. I apply it with overwhelming force, but, and this is crucial, only when the odds are dramatically in my favor. I've developed a specific framework for identifying these opportunities. First, I look for situations where political pressures conflict with market realities. Second, I analyze whether central banks are fighting unwinnable battles. Third, I determine if market participants are overlooking critical structural weaknesses. When these elements align, I position myself accordingly, not with a modest allocation, but with the maximum position size my risk parameters allow. This approach isn't for everyone. It requires deep market knowledge, iron emotional discipline, and substantial capital reserves. But for those who master it, concentrated positioning transforms ordinary returns into extraordinary wealth. This isn't just how I built my fortune. It's how I changed financial history. I am Paul Tudor Jones, and I've built my fortune by understanding a paradox that most traders never grasp. Sometimes, bigger bets create greater safety. This counterintuitive principle has been the cornerstone of my 40-plus year career managing risk in the markets. When I started Tudor Investment Corporation in 1980, I already knew that conventional wisdom about position sizing was fundamentally flawed. Let me explain this paradox. Most traders believe smaller positions equal safety. They're wrong. I found that properly structured larger bets, when paired with ruthless risk management, actually create a safer portfolio. This isn't recklessness, it's mathematical precision. I discovered this principle during the 1987 crash when I tripled my fund's value by taking massive short positions. I didn't just get lucky, I structured these positions with precise risk parameters. My positions were large, but my potential losses were strictly defined and relatively small. The key is what happens after I place the trade. I establish non-negotiable stop losses that I execute without hesitation. During the October 1987 crash, I had massive short positions in S&P futures. But had the market reversed against me, my stops would have triggered automatically. My potential loss was capped at a predetermined percentage. I've watched countless traders fail by taking small positions without stops. They think they're being conservative, but they're actually gambling. Their small position gives them false confidence to hold losing trades indefinitely. I'd rather take a larger position with a tight stop than a small position with no exit plan. This approach requires extreme discipline. In 1994, I lost $40 million in a single day trading Japanese yen, nearly 8% of my fund. I immediately cut the position. My rule has always been, I can be wrong, but I refuse to stay wrong. When I'm wrong, I get out. The mathematics of survival demand this approach. If you lose 50% of your capital, you need 100% gain just to break even. I never allow myself to take that kind of drawdown. By taking larger positions with strict risk parameters, I ensure that no single loss can significantly damage my capital base. My strategy creates psychological benefits too. When you know exactly how much you're willing to lose before entering a trade, you trade with clarity. You don't become emotionally attached to positions. You don't rationalize losses. You execute your plan with military precision. Remember this, in trading, it's not the size of your position that determines risk. It's the size of your potential loss. I've survived and thrived through multiple market crashes because I understand this distinction. Size your positions according to conviction, but always know your maximum downside and honor it religiously. That's how bigger bets paradoxically create greater safety in your trading. I am Warren Buffett, and I've made billions by understanding a fundamental truth that most investors miss. True wealth comes from concentration, not diversification. The conventional wisdom you've been fed about spreading your bets is designed to create mediocrity, not excellence. I call this the concentration paradox. When others diversify, I bet big. When I started Berkshire Hathaway, I didn't build a portfolio of hundreds of stocks. I focused on a handful of exceptional businesses I truly understood. In 1988, I purchased $1 billion of Coca-Cola stock, 7% of the company. This wasn't a casual position. It represented over 35% of Berkshire's portfolio at the time. I knew the business inside and out, and I was willing to make a massive bet while others diversified their risk away. My approach contradicts everything taught in modern portfolio theory. Academics will tell you that diversification reduces risk, but I've always believed that concentrated investing reduces risk if, and this is critical, you know what you're doing. Diversification is protection against ignorance. It makes little sense if you know what you're doing. I've consistently applied this principle throughout my career. When I find an exceptional opportunity, I don't nibble. I take a massive position. In 1989, I invested $358 million in Wells Fargo when banking stocks were being decimated during the savings and loan crisis. Everyone thought I was crazy. The position grew to be worth billions because I understood the business fundamentals when others were panicking. Let me be clear about what concentration requires. First, I develop what I call a circle of competence, areas where I have deep knowledge and understanding. I don't invest in businesses I don't understand, no matter how attractive they might seem. This discipline has kept me out of countless disasters, including the dot-com bubble and cryptocurrency manias. Second, I look for businesses with durable competitive advantages, what I call economic moats. These are companies that can sustain high returns on capital because they have something special that competitors can't easily replicate. When I find these rare businesses selling at reasonable prices, I commit significant capital. Third, I maintain extreme patience. The stock market is a mechanism for transferring wealth from the impatient to the patient. I waited years for the right opportunity to invest in Geico before finally purchasing the entire company. My best investments have often been my largest and longest held positions. The concentration paradox works because most investors can't handle the psychological pressure of concentration. They diversify not for mathematical reasons, but for emotional comfort. When you own 30 stocks and one drops 50%, your portfolio barely notices. When you own 5 stocks and one drops 50%, it hurts. This pain drives most investors toward diversification. But here's what I know after decades of successful investing. Extraordinary returns come from concentrated bets made with extraordinary conviction. The market rewards conviction when it's backed by deep understanding. My billions weren't made by spreading small bets across hundreds of companies. They came from making massive, concentrated investments in businesses I understood better than anyone else. I am George Soros. And when I founded the Quantum Fund in 1973, I had no idea it would become the vehicle for what many call the most audacious currency trade in history. My partnership with Jim Rogers created the foundation for what would eventually become a $40 billion empire. I'm going to show you exactly how I structured my fund to enable billion-dollar bets that most traders could never execute. When I established Quantum, I deliberately chose an offshore structure based in Curacao. This wasn't random. I wanted regulatory flexibility that would allow me to make concentrated bets without the position limits imposed on domestic funds. I needed the freedom to go all in when my conviction was strongest. This is something most traders fail to understand. Your organizational structure directly impacts your trading capacity. I designed my partnership model with a critical feature. I took 20% of all profits. This incentive structure aligned my interests perfectly with my investors. When they won, I won significantly. This created what I call positive reflexivity within the fund itself. Success bred more success, attracting better talent and more capital, increasing our firepower for future trades. My partnership with Jim Rogers was instrumental during Quantum's early years. I handled the macro framework and currency positions while Jim focused on commodities and stocks. This division of expertise allowed us to attack markets from multiple angles simultaneously. I've observed that solo traders often fail because they lack perspective diversity. My partnership model solved this problem. By 1981, I had grown Quantum to $381 million in assets. What most people don't understand is how I used this capital base to create exponential leverage. I maintain relationships with multiple prime brokers, each unaware of my total positions across institutions. This gave me access to leverage that would have been impossible through a single counterparty. I structured my positions using a combination of spot currency trades, futures, and options. This wasn't just about amplifying returns. It was about creating positional flexibility. When I attacked the British pound in 1992, I built positions across multiple instruments and time frames. I could adjust my exposure minute by minute as market conditions evolved. My partnership model included another crucial element. I surrounded myself with traders who thought differently than I did. Stanley Druckenmiller joined me in 1988, and his addition proved invaluable during the Bank of England trade. While I provided the macro framework, Stan executed with precision. This partnership dynamic created what I call intellectual leverage, multiple minds attacking the same problem from different angles. The quantum fund structure gave me another advantage few recognize: patient capital. I insisted on lockup periods that prevented investors from withdrawing during market turbulence. This meant I could hold positions through volatility that would force other funds to liquidate. When I bet against the Thai baht in 1997, I maintained my position despite significant drawdowns before the currency finally broke. Remember this: the structure of your trading vehicle is as important as your trading strategy. I designed quantum specifically to enable massive concentrated bets when asymmetric opportunities presented themselves. Without this foundation, billion-dollar trades would have been impossible regardless of my market insight. I am Stanley Druckenmiller, and I've managed billions throughout my career with one fundamental principle that separates me from average traders. Risk management isn't about avoiding pain. It's about calibrating your threshold for it. When I ran Duquesne Capital for 30 years, I averaged 30% annual returns without a single down year. Not because I avoided losses, but because I embraced them strategically. Let me tell you how I reimagined risk management. Most traders set arbitrary stop losses, 10%, 15%, whatever. That's mechanical thinking, and the market eats mechanical thinkers alive. I developed what I call the pain threshold approach, where your position sizing directly correlates to your conviction level and the market's structural opportunities. In 1992, when I bet against the British pound alongside George Soros, I didn't limit my risk to some predetermined percentage. I sized my position based on my conviction that the Bank of England couldn't maintain their currency peg. When the opportunity presented itself, I went all in. We made over $1 billion in a single day. Had I used conventional risk management, we might have made just millions. Here's my framework. First, I determine my conviction level on a scale of 1 to 10. For a level 10, conviction, like the pound trade, I'm willing to risk 5% of my portfolio. For a level 5 conviction, maybe 1 to 2%. My pain threshold scales with my certainty. Second, I monitor the trade's behavior, not just price. Is the market confirming my thesis? When I shorted tech stocks in early 2000, I watched how stocks reacted to good news. When Cisco beat earnings but the stock dropped anyway, that confirmed my thesis and I increased my position. The market was telling me I was right. Third, and this is critical, I never average down on a losing position unless new information strengthens my original thesis. When I'm wrong, I get out. Period. In 1999, I initially lost money fighting the tech bubble too early. But I didn't stubbornly hold my position. I adapted, actually went long tech temporarily, then reestablished my shorts when the timing was right. My pain threshold isn't about enduring unnecessary suffering. It's about precisely calculating how much pain is appropriate for each opportunity. When the reward justifies it, I can withstand significant drawdowns. When it doesn't, I cut losses immediately. This approach requires brutal honesty with yourself. When I'm wrong, I say, I'm wrong. No excuses, no narratives, just acceptance and adaptation. This saved me during the 2008 financial crisis when I recognized the severity early and positioned accordingly. Remember, the market doesn't care about your feelings or your arbitrary rules. It rewards those who can endure the right amount of pain at the right time. Most traders fail because they either can't take enough pain when they should, or they take too much when they shouldn't. Master your pain threshold, and you master the market. That's not theory. That's how I built my fortune. I am Stanley Druckenmiller, and I built Duquesne Capital into a $12 billion powerhouse using one core principle: concentrated betting. While most money managers diversify themselves into mediocrity, I've generated over 30% annual returns for decades by taking massive calculated positions when I see asymmetric opportunities. Today, I'm going to teach you the Duquesne method that made me a billionaire. My approach is deceptively simple but extraordinarily difficult to execute. When I see a major market inefficiency, I don't just dip my toe in the water. I dive in head first with significant capital. I've always believed that diversification is protection against ignorance. It makes little sense if you know what you're doing. Let me take you back to 1988 when I made one of my most concentrated bets. I became convinced the Japanese stock market was massively overvalued and due for a collapse. While other fund managers were still piling in, I took a substantial short position against the Nikkei. When it finally crashed in 1990, I made hundreds of millions. This wasn't luck. It was conviction backed by thorough research. I apply 3 key principles with every concentrated position I take. First, I focus on capital preservation above all else. This might sound contradictory when taking large positions, but I'm ruthlessly disciplined about cutting losses. I never let my ego prevent me from admitting I'm wrong. If the market moves against my thesis, I get out. Period. I've found that my first loss is always my smallest loss. Second, I pay obsessive attention to market liquidity and capital flows. I don't just analyze company fundamentals. I track where the big money is moving. In 1992, when I helped George Soros break the Bank of England, we weren't just betting against a currency. We were betting against an unsustainable economic policy in the face of massive capital outflows. The position was enormous, but the asymmetry of the bet was clear to me. Third, I maintain extreme flexibility. Unlike most fund managers who get married to their positions, I have no emotional attachment to my trades. I've completely reversed my market stance within 24 hours when new information emerged. During the 2008 financial crisis, I pivoted from being net long to aggressively short within days, as I recognized the severity of the banking collapse. This adaptability has saved my capital countless times. My concentration strategy requires exceptional risk management. I don't just size positions based on potential return. I calibrate them based on how much I'm willing to lose if I'm wrong. When I'm highly convicted, I might risk 3 to 5% of my capital on a single position. This is far more than conventional wisdom suggests, but it's how generational wealth is created. The Duquesne method isn't for everyone. It requires iron discipline, deep market knowledge, and psychological fortitude few possess. But for those who master it, the rewards are extraordinary. I've used this approach to navigate every major market cycle since the 1980s, from the crash of '87 to the dot-com bubble to the 2008 financial crisis. Through it all, concentration, not diversification, has been my path to billions. I am Stanley Druckenmiller, and in 1992 I made one of the most legendary currency trades in history by betting against the British pound. Working alongside George Soros at the Quantum Fund, I initially allocated $1.5 billion to this position before eventually increasing it to over $10 billion. The trade netted us over $1 billion in profits in a single day and forever changed how markets view central bank interventions. Let me take you inside my thought process for this historic trade. I didn't just stumble into this opportunity. I methodically analyzed the fundamental economic imbalances that made the pound's position in the European exchange rate mechanism, ERM, unsustainable. My analysis began with recognizing a critical macroeconomic divergence. Britain had entered the ERM at an artificially high exchange rate of 2.95 German marks per pound. This rate was politically motivated rather than economically sound. I observed that Britain was suffering from high interest rates, declining property values, and rising unemployment, a perfect economic storm. The first principle I applied was identifying policy contradiction. The British government was trapped between maintaining high interest rates to defend the pound and needing lower rates to stimulate their struggling economy. This contradiction created an unsustainable situation that markets would eventually force to resolution. I carefully monitored the statements of British officials, particularly those from the Chancellor of the Exchequer, Norman Lamont. When he declared that Britain would do whatever it takes to defend the pound, I recognized the classic language of desperation. In my experience, when government officials make absolutist statements about currency defense, it often signals weakness, not strength. My second principle was position sizing based on asymmetric risk-reward. Initially, I put on a $1.5 billion short position, but as my conviction grew, I increased it substantially. Why? Because the downside was limited. The pound couldn't rise much above its trading band, while the potential downside was enormous if Britain abandoned the ERM. I remember telling my team, the risk-reward here is the best I've seen in my career. If we're right, we make billions. If we're wrong, we lose a small percentage of our capital. When Black Wednesday arrived on September 16th, 1992, the Bank of England tried desperately to defend the pound by buying billions on the open market and raising interest rates from 10% to 12% and then to 15% in a single day. I watched this unfold, knowing their efforts would fail against market forces. By evening, Britain announced its withdrawal from the ERM, and the pound plummeted 15% against the German mark. My position generated over $1 billion in profit in just 24 hours. The key lesson I want you to take from this trade isn't about the money. It's about recognizing fundamental economic contradictions that cannot persist indefinitely. When a government tries to defend an artificial price, whether in currencies, commodities, or any market, against fundamental economic reality, the market eventually wins. I've applied this same principle throughout my career. Identify situations where policy goals contradict economic reality, ensure the risk-reward is asymmetrically in your favor, and size the position according to your conviction level. This approach has been the cornerstone of my most successful trades over decades in the markets. I am Stanley Druckenmiller, and I've generated billions in returns over decades by rejecting conventional wisdom about diversification. When I managed George Soros's quantum fund and later my own Duquesne Capital, I built my fortune on concentration, not diversification. Let me teach you why most investors get this fundamentally wrong. I don't diversify, I concentrate. The conventional wisdom tells you to spread your bets across many positions to reduce risk. That's garbage thinking for serious wealth creation. And when I see a truly exceptional opportunity, I don't put 2% of my portfolio in it. I put 20% or even 30%. I've built my entire career on making fewer, larger bets with higher conviction. When I identify a major market inefficiency, I strike with size. During the British pound crisis in 1992, working with Soros, I didn't take a small position. I built a $10 billion short position against the Bank of England. We made over $1 billion in a single day when the pound crashed. That doesn't happen with tiny diversified positions. I've always believed that diversification is protection against ignorance. It makes little sense if you know what you're doing. Look at my track record. 30% average annual returns over 30 years without a single down year. I didn't achieve that by spreading tiny bets across hundreds of positions. My approach requires 3 critical elements that most traders lack. First, I develop deep conviction through exhaustive research. I don't just read analyst reports. I build comprehensive models, speak with industry insiders, and understand businesses at their core. Second, I maintain rigorous risk management despite concentration. I know exactly how much I can lose before I enter a position. Third, I have the psychological discipline to cut losses when I'm wrong. I've watched countless portfolio managers destroy capital by clinging to the diversification myth. They end up with a portfolio so diluted that even their best ideas barely move the needle. When I find a truly asymmetric opportunity, I want it to matter. My approach isn't for everyone. Most traders lack the discipline, research capabilities, or psychological fortitude to handle concentrated positions. But for those who can develop these skills, concentration creates generational wealth, while diversification ensures mediocrity. Consider my bet against tech stocks in 2000. As the NASDAQ approached 5,000, I recognized the bubble's unsustainability. I didn't take a small hedge. I concentrated heavily on shorting overvalued tech companies. When the bubble burst, my concentrated position generated enormous returns, while diversified investors were devastated. The mathematics is simple. Your best ideas will always outperform your 20th best ideas. Why dilute your returns with inferior opportunities? I've always focused on my highest conviction trades and sized them accordingly. Remember this: the market doesn't reward you for activity. It rewards you for being right. I'd rather make 3 great trades a year than 300 mediocre ones. Concentration requires courage, conviction, and superior analysis, but the rewards speak for themselves. My multi-billion-dollar net worth wasn't built on small, diversified positions. It was built on concentration with conviction. I am Paul Tudor Jones, and I've built my fortune navigating the paradox that confuses most traders: how to go all in on conviction while simultaneously protecting your capital. This isn't theoretical. It's the exact approach that helped me predict the 1987 Black Monday crash and triple my money when others lost everything. Risk management isn't just about survival. It's about thriving when others collapse. I've spent decades perfecting this balance, and I'm going to teach you exactly how I approach it. The first principle I live by: I never risk more than 1 to 2% of my capital on a single trade. This isn't negotiable in my system. When I took my famous short position before the 1987 crash, I structured it to limit my downside while maximizing my upside. Most traders get this backward. They risk 10-15% per position, ensuring eventual ruin. I've watched countless brilliant analysts go bankrupt not because their ideas were wrong, but because their position sizing destroyed them. Here's what I actually do. I calculate my stop loss first, then determine position size based on my maximum acceptable loss. If I'm willing to risk $10,000 on a trade with a $2 stop, I'll take 5,000 in shares. If that same trade requires a $5 stop, I'll take only 2,000 of shares. The mathematics of survival demands this discipline. My second principle. I go all in through multiple, carefully constructed bets, not one massive position. In 1987, I didn't just place one trade. I built a pyramid of positions that all expressed my conviction from different angles. I bought puts, shorted futures, and positioned for volatility expansion. Each individual position followed my risk parameters, but collectively they expressed my high conviction. The market doesn't reward people for being right. It rewards people for being right and properly positioned. I've seen traders correctly predict major moves, but still lose money because they structured their trades poorly. Third, I use asymmetric bets religiously. Every position I take must have the potential to make at least 3 times what I'm risking. Before Black Monday, my options positions had 10-to-1 payoff potential. This approach means I can be wrong more often than I'm right and still make money. Most traders do the opposite. They take small profits and large losses, a mathematical formula for account destruction. When I train new traders at my firm, I hammer this home. You can be right only 40% of the time and still make fortunes if your winners are much larger than your losers. I've applied this across every market condition for over 4 decades. The paradox resolves when you understand this. Going all in doesn't mean one giant bet. It means expressing strong conviction through multiple mathematically sound positions that collectively give you massive exposure while individually following strict risk parameters. I've survived every major market crash since the 1970s because I respect risk first, then pursue reward. Master this balance, and you'll outlast 99% of traders who eventually blow up their accounts through poor position sizing and risk management. I am Stanley Druckenmiller, and I've generated over 30% annual returns for decades through what I call the Duquesne method, a psychological discipline framework that separates the elite from the average trader. When I managed George Soros's quantum fund and later my own Duquesne capital, I wasn't just trading markets, I was mastering my own psychology. Let me teach you what I know about psychological discipline. The foundation of my 30% returns isn't some secret indicator or complex algorithm. It's my ability to maintain absolute mental clarity when billions are on the line. My first principle is conviction concentration. When I see a truly exceptional opportunity, I don't diversify. I concentrate. In 1992, when I convinced Soros to build our massive position against the British pound, I wasn't placing a casual bet. I had put together all the evidence and built such overwhelming conviction that I was willing to risk billions on a single trade. Most traders dilute their best ideas across dozens of positions. I've always done the opposite. I concentrate capital in my highest conviction ideas. The second element of my method is loss acceptance. I'm never emotionally attached to any position. When I'm wrong, I exit immediately. In 2000, I initially missed the tech bubble burst, losing 15% on the long side. But unlike most traders who freeze or double down, I completely reversed my position within 6 weeks. I didn't just cut losses. I aggressively shorted the NASDAQ and recouped everything. My willingness to admit I'm wrong and change direction is why I've survived for decades. My third discipline is trend alignment. I never fight the primary trend. When the Federal Reserve began aggressively cutting rates in 2007, I recognized the implications for gold and built a massive position. While others debated whether gold was a good investment, I was simply aligning with the inevitable consequences of monetary policy. I made over $1 billion because I aligned with the primary trend rather than fighting it. The fourth element, and this is critical, is pain tolerance. Trading isn't comfortable. In 1987, when I shorted the market before the crash, I endured weeks of mounting losses before the crash validated my position. Most traders can't handle the psychological pain of watching positions move against them, even when their thesis remains valid. I've developed the discipline to distinguish between normal market fluctuations and actual invalidation of my thesis. Finally, I maintain what I call flexible stubbornness. I'm stubborn about my process, but completely flexible about my positions. In 2011, I built a large position in European banks, believing the crisis was overblown. When new information emerged that contradicted my thesis, I didn't hesitate to reverse course. My ego isn't tied to my initial analysis, it's tied to my P&L. This psychological framework, conviction concentration, loss acceptance, trend alignment, pain tolerance, and flexible stubbornness, is what I've used to generate consistent 30% returns. It's not about having better information than everyone else. It's about processing that information with greater clarity and acting with greater conviction than anyone else in the market. I am Stanley Druckenmiller, and I'm going to teach you the most counterintuitive lesson that made me billions. Concentration, not diversification, creates real wealth. When I managed George Soros' Quantum Fund and throughout my career at Duquesne Capital, I built my fortune by doing the exact opposite of what most financial advisors preach. I don't believe in the don't put all your eggs in one basket nonsense. That creates mediocrity. When I see a massive opportunity, I go in heavy, very heavy. I've made more money on my top 5 positions than all others combined. This is what I call the concentration paradox. The path to reducing real risk is through focused conviction, not spreading yourself thin. Let me take you back to 1992, when I convinced Soros to build a $10 billion short position against the British pound. Most portfolio managers would have allocated 1 and 2% to this trade. I put in over 100% of our capital by using leverage. When the Bank of England finally capitulated on Black Wednesday, we made $1 billion in a single day. One trade, massive concentration, life-changing returns. I approach markets like a predator. When I see weakness, I don't nibble. I pounce with everything I have. In 2007, I recognized the housing bubble was about to implode. While others diversified their risk, I concentrated my positions in gold and shorted financial stocks and home builders. My conviction paid off when the market collapsed in 2008. Here's my core philosophy. Diversification is for people who don't know what they're doing. It's protection against ignorance, not against market risk. True risk management comes from deep knowledge and timing, not from spreading bets across dozens of positions. I've found that my biggest mistakes weren't from concentration. They came when I violated my own discipline. In 2000, during the dot-com bubble, I abandoned my value principles and bought technology stocks near their peak. I knew better but followed the crowd. That mistake cost me 12% of my fund's value, and I deserved every bit of that loss. When I identify a major market opportunity, I follow 3 rules. First, I size a position according to my conviction. If I'm extremely confident, I might allocate 30-40% to a single trade. Most financial advisors will call this insanity. I call it conviction. Second, I remain incredibly liquid. Concentration requires the ability to exit quickly if I'm wrong. I never get locked into positions I can't escape. Third, I focus fanatically on risk management through entry and exit points, not through artificial position limits. I cut losses quickly and let winners run massively. The average investor owns too many stocks and knows too little about each one. They end up with index-like returns minus fees. That's a guaranteed path to mediocrity. I'd rather own 5 stocks. Understand deeply than 50 I know superficially. My billion-dollar lesson is simple. When you find an exceptional opportunity with asymmetric risk-reward, bet big. The greatest fortunes in market history, from Soros to Buffett to myself, came from concentration, not diversification. The paradox is that what seems safest to most investors is actually the riskiest approach of all.